Welcome back to We Hate Money, episode 6. It's Wiz and I. How are you, mate?
I'm doing well, Arnie. We're on the
So,
rush.
yeah, we are. I got a quick one today because I got to run. But, mate, there's a lot going on in markets in general. Where do you want to start?
Well, anything that's caught your eye specifically? I mean,
Yeah,
I'd
I.
probably start with yields, but what do you want to,
Oh no, you
what do you
talk
want to take?
about yields, and then I'll talk about one stock in particular, which I mentioned to you before. But yeah, what's
Oh,
going on with
yeah.
yields?
Well, last week, everyone kind of felt like they were getting a bit, maybe like a cooling off period after they've moved up substantially. But this week seems like maybe yields aren't quite done going up yet. And the dollar is, I think the DXY is over 107, just a smidge over 107 closing today. So things are looking interesting as we're closing in on the all-time high there. Well, I guess the recent high. I wouldn't say all-time high.
Yeah, what is the all-time high? I don't even know.
You know, I, I I haven't actually looked at the longer chart more than 10 years, but
Oh,
I'm pretty sure. Yeah.
you want to have a guess? I've got it
No,
up. I've got it up here. Do you want to have a guess at what it was?
oh,
It's a long time ago. I'll say that. It was in 85.
I'll say maybe 150.
164.72. That was a pretty good guess though, Wiz.
Okay. Yeah, it's within almost 10%, not bad.
Do you know what the low was, which occurred on March 16, 2008?
Oh, um, I'll go with like 75.
Oh, also a pretty good guess. It was 70.698.
I'm just good at almost getting it right.
Approximation is the name of the game. Yeah, so
But
so
yeah,
yields are going up, Dixie's going up, and you were telling me earlier that one of our favorite banks might be in trouble, along with a few others.
yeah, there's a couple of rumors going around. God, don't actually listen to rumors, right? But um, apparently, Bank of America might be struggling with cash flows of some kind. So, if that is the case, um, the only way for them to make payments would be to start to either, sell off equity or to, put mark their bonds to market, which I'm not sure which way you want to go there.
Well, I think they'd want
But
to avoid the bonds because, as we've seen in Silicon Valley and Signature Saga, and as we saw in the UK with their whole mess, if they start trying to sell bonds, that pressure is just going to cause them to make further and further losses. So they got to find some other way of getting. If it's true, the rumor, and it's just general in nature, they need to find some other way of getting liquidity if they're going to weather the storm, or pray like hell that the Fed is ready to cut rates in an instant, or maybe they've got some other creative way of saving the banks.
yeah, I think they will probably try to do a different approach to saving the banks because the banks, they're not the economy, right? And if Bank of America gets into trouble, that doesn't mean it's going to blow up and cause like a Lehman moment. So they've got plenty of assets. It's just offloading those assets in a structured way or doing some sort of swaps with the Fed. So we'll see how that goes. I don't know. If they can stabilize them, it should be fine. So I think it depends on the nature of the crisis.
I think, yeah, like saying, well, it's so hard to know because if there's no or low confidence in Bank of America, one of America's biggest banks, one of the big four or five, that could cause like a way worse run on banks than we saw with Signature, and Silicon Valley. So I think there could be cause for contagion there.
Yeah, what made Silicon Valley unique was the size of the accounts were far above average. And I mean, far above average. And most of a Bank of America's, I guess, deposits are from regular folks, so more in line with the average, bank account numbers as far as that's concerned. I don't know if those people are going to try to pull all of their cash out of Bank of America because of liquidity rumors or anything like that. So we'll see if that does happen. It would be chaotic because they have so many retail clients. It's not even funny.
It's definitely one to keep an eye on, mate. I've sort of loosely been paying attention to that, as you and I both do, because this kind of economic news is what's going to make or break.
I mean,
the
small
next...
businesses might flight sooner because they have more emergency needs. If you live in a household, most of your bills go out monthly, right? They're not bi-weekly. So if it landed right, you may not feel the pressure to suddenly go out and pull all your money out of Bank of America. Maybe that's a bad feeling to have. But to me, it's going to depend on the timing. It's going to depend on the severity of the issue. So
fair enough, mate.
Hopefully not. Yeah, sorry.
Yeah,
yields creating pressure for banks again. I think bank deposits overall are down 25%. So that's also a bit concerning.
I mean, why would anyone put their money in a bank when they're paying next to no interest and you can get a greater return on your money in some sort of money market fund, or even just holding it in your brokerage? Like at the moment, Interactive Brokers is paying a very good rate on cash balances. So
yeah, my retirement fund has a money market fund in it that does 4.6%.
Absolutely. And what's your bank paying out of comparison? Like, have you checked?
I think the last time I looked, I was getting like 1.25, 1.3%.
Yeah, it's a bonkers spread, man. Like, why would why would anyone keep their money in there? It's and I mean, obviously, it keeps the money in there for day-to-day purposes, to, running expenses and whatnot. But yeah, like
5% yield is massive in a money market fund. That's a lot of money.
Absolutely, man.
Whether people realize it or not. Where yields are getting so high, why would you want to keep your money in equities at all? Utilities got totally slammed today. Just no support for them at all. I think it's the XLU's just been crashing just nonstop for the past week or two. And yeah, something's going on with me. Who knows? I think it was down almost 10% today. And it's kind of, I think, dragging the rest of that index down with it.
Which one did you mention? Sorry, who was it?
XLU. NE. You can look. I posted a heat map further up in the chat.
Okay, I'll check. Oh yeah, let me have a look here. While I'm looking for that, I'll just quickly mention, that for a little while now, I've been tracking some of the US publicly listed REITs, real estate investment trusts, because on the horizon, we've heard about this sort of issues with commercial real estate in America, and sort of got me thinking about, if something occurs where we see a crash in commercial real estate, I wanted to sort of get ahead of it and have a little bit of a look at which ones had high quality assets that still might take a hit if there's a bit of a crisis in commercial real estate, but that might recover quickly or have chances to get something that's undervalued, basically.
Yeah.
And one that I was sort of have had my eye on for a little while is VICI properties. So that's VICI, and they're predominantly in casinos and lodging, which I would say is still very susceptible to consumer spending, but maybe not as much as like, I don't know, like people who rent offices and stuff like that. I feel like the office rental spaces and, I don't know, multi-family homes and whatnot, those ones might be more exposed if a crisis comes along, as opposed to like casino spaces or whatever, or golf, or golfing sort of properties. And overnight, Vici took took a bit of a hit, and it's down to its 52-week low, trading at, I believe, 28.65, but it rebounded a bit after hours. And I'm sort of been having a look at this, mate, and I might dip my toe in here, but I would prefer to get in lower again. At the COVID 2020 lows, second quarter 2020, it was 16.64, this stock. And that's the lowest it's been ever, because I think it started trading in 18, and so anyway, one to keep an eye on, Wiz, and I know they've got their earnings coming up soon, so the earnings for Vici will be on October 25th, and I'll be paying close attention to what they say there. So might, general in nature, do your own research, but I might dip my toe into this one and then wait and see what happens with the earnings in approximately a month's time.
I would say it might be a good play there. With the 30-year putting so much pressure on REITs as well, home builders are struggling as well too, because the higher the 30-year goes, the less interest you have from buyers. Right now, there's sort of an interesting phenomenon. While the long, I think we're almost to 8% on 30-year mortgages, and that's fixed, right? So, and some of with median home price is almost $500,000. I think you're seeing that inability for the people who have to sell and they have to buy are looking around, and I think their options are less than they probably would like.
I read something last night on a news article saying that 80%, I forget which body did this, but some American body has now said that housing in America, like 80% of housing in America, is unaffordable to constituents that are local to those areas.
I think it's worse than that. I think it's 80% of all counties in the United States.
Which is unbelievable, right? So if anyone wants to buy a house, like 80% of people are priced out of the market, basically, at the current rates and capital at asset prices.
Oh, absolutely. I mean, because where are the 20 counties where it's affordable? Are we talking in Montana? North Dakota? I mean, because if you do it by counties, it covers a massive amount of the population. I mean, you could probably be looking closer to 90% of people being unable to afford. So I would say it's pretty crazy.
Yeah. So just while we're chatting, so I know we're flicking between things here, but I've been just having a look at like Vici's website. So you can go and have a look at VICIproperties.com if you want to. And it's got a little pie chart of like what their exposure is to gaming destinations across the United States and Canada. So they've got 47% of their casino properties are on the Las Vegas Strip, 52% is regional America, and 1% is international. And then if you're on their page, you can sort of scroll down from their biggest casinos down to, like they've got a listing for every holding. And I think it's important to differentiate here that these guys own the property. They're not the operator of the venues. And like just for example, like there's one in the Hard Rock Casino, Cincinnati. Obviously, the operator is Hard Rock, not Vici. They just collect the rent from Hard Rock. And they've also got a few golf courses as well. So they've got like 4 golf courses, I believe. And I was sort of having a bit of a think about this, and my loose hypothesis for this, Wiz, is, if we hit a recession, if we hit hard times and commercial real estate takes a hit, then you would expect an overall decrease in consumer spending in these kind of products and services, like entertainment products and services. But I do think that at the same time, historically these kind of entertainment services tend to fare relatively well, because people want to sort of escape, the humdrum or like what's the word for it? Like I guess the blues, like that a recession might induce. So yeah, will this company survive? I think it'll survive and eventually thrive. That's my loose hypothesis for it.
Yeah, I mean, once it's possible it's being punished because of its company that it's in, So if it's in any REIT, ETFs, things like that, that has downward pressure on them as well. So we'll just have to see what the earnings say, but it may be a good sale. So
I know
nothing
this
wrong with
is
that. The
this is
problem
like
with
sorry, go on. Oh, I'll just quickly throw in here that like I was just reading something about I know this is not the exact same industry, but there's some statistic here that says during the last 8 recessions in America, box office sales in theaters have increased 6 times over. So people seeking sort of entertainment and comfort during these difficult times. Now, is gambling in the same vein? Maybe not. But anyway, something to think about. What were you going to say, mate?
well, they do a lot of entertainment in Vegas too, not just gambling. So
True.
I mean, yeah, you never know. But I think people go to gamble a little bit just to feel like they might be able to get a little money. And the odds of winning in gambling are much better than winning in the stock market. So,
I don't know about
uh,
that.
well, everyone's buying, so everyone wins. That's the idea, right? Um, well, I would say with yields, everyone has to also remember that there's a competitive nature to U.S. Treasuries because they're very high quality products. And when they start putting out a yield of close to 5% over 5 to 10 years, that's very attractive. And it's also very expensive to do certain funding measures like stock buybacks, things like that. So I think we're going to start seeing yields start to have compounding effects on earnings and on performance. So that's something else people need to keep in mind as we move into the first quarter of 24 is what's the damage that's been done from an entire year of higher for longer.
That's true, mate. That's true. Anything else you want to cover today? Anything else that's tickling your pickle in the stock market or bond market?
Nothing. Well, all eyes on Japan tonight. Apparently,
Mm-hmm.
they have to defend the yen again. I think they've done it 3 times. Somebody said. I don't know. I don't have a trading view of their bond buying and purchasing platform. So, um, but it could get interesting. We'll see overnight. It looks like we're at a point where we're either going to break down or we're going to rebound higher. So, the market seems convinced that the higher yields really aren't an issue right now, unless you look at utilities. And the reason utilities are down are because the only reason you buy utilities is really for the exposure to the dividends, right? And those dividends are around what, 3.5%? So you've got the 30-year going 4.7 something percent right now. That's massive.
That is
So
massive.
the duration risk is another thing, something that people need to educate themselves about. But I mean, there is no treasury below 4%. So why would you even entertain the risk of running a utility over a guaranteed payback within a shorter time frame than 30 years, obviously? But still, it's causing a problem for utilities, and we'll have to see what the problem is with NE, because 9% because of yields seems a bit excessive. in one day. That's just one day's move. So it's just absolute slaughter. Maybe a rebound play,
Yeah.
actually, out of the XLU. It's
Hmm.
deeply oversold, um, deeply punished. So, it may be starting to get attractive for some of those prices as a long-term hold. They still pay out dividends, but it will get tougher because of the higher yields for them to pay out those dividends. So, all those problems are coming forward. Maybe people are doing the calculus on that as well. So just trying to place their bets on, well, maybe growth is the last game in town. So maybe we
Hmm.
see a melt up in the Nasdaq, which will drag SPY up with it. I mean, I think the top 5 names in SPY are 21% of the 25% of the 20% of the S&P. I mean, that's all tech.
That's crazy.
So if
It's a
tech
heavy
has,
weighting.
yeah, that is, and it's just 5 names, and there's more tech below that. So I mean, I think the tech weighting's like 20 odd percent. It's all the top several spots. Um,
Hmm.
I think you can see where you have the rest.
Oh, I just lost you, Wiz. I think you just got muted, mate. But hear what you're saying, and it's an interesting picture you paint. I know we're sort of pushed for time today, so there's one or two things I wanted to quickly discuss with you. First one is like one, I guess, maybe a darling of the We Hate Money podcast. Not that I don't think either of us own it, and it's general in nature, but SOFI, the fintech enterprise, there's potential
To
catalyst.
be resilient.
Oh, sorry, Wiz, we
Yeah.
just got you back. So
Oh, sorry.
I jumped in there, mate, because something happened with your connection. But appreciate you giving us the guidance there. But I was just starting to talk about SoFi and how a catalyst has just occurred for SoFi because, as we know, the resumption of federal student loan payments has occurred in, I think, recently, like this month in October. So maybe the potential
Yeah,
there to see
today.
today. Yeah, today. That's right. And I think earnings for SoFi are on October. Oh, it's the week of October 30th to November the 3rd. So we got a sort of a bit of a month to sort of see how things are playing out. Um, Interestingly, one thing that could potentially, like, obviously, like the loan book for SoFi has exploded, and a lot of it is with these sort of student loan or personal loans. I think it represents about 80% roughly of the company's overall lending,
Yeah.
or something like that. I, so basically, it's an interesting thing to sort of think about, like how will this, as a positive catalyst, affect SoFi? One thing to think about as well, though, is that with inflation so high, people having less income to service these kind of loans, are we going to start to see defaults? So if there's a chance of default on these personal loans, which make up, I think the personal loans make up around 2/3 of their loan book, not including. Yeah, anyway, I'm not exactly sure, but if the macro conditions worsen and interest rates have to rise again, it could be like losses compounding for SoFi. So I'm not exactly sure which way this one's going to go. It's obviously impossible to predict, but I think it's an interesting play that you and I have been keeping an eye on. And yeah, and I guess normally this is one I would sort of steer clear of because even though they've got increasing revenue year on year, they're still haven't made any money from an earnings perspective. But it's something that could potentially change with this catalyst. Another one I wanted to quickly
Yeah.
throw in here before we wrap up is one of our friends of the pod, Yellow Fellow. Shout out Yellow. I don't know if he listens or not. And you as well have been in Bed Bath and Beyond, and there was big news out of Bed Bath and Beyond that there's potential for a cash plus equity payout, or maybe all cash with a if it's all cash, it's a ceiling of $25 a share. If it's cash equity, it's a floor of $25. So I'm just going off what Yellow said.
I haven't heard anything about it. I mean, that would be a relief to me.
Well, yeah, I mean, just take it with a grain of salt because I haven't looked into it. I just saw Yellow talking about it because I know he's got a big position, and I wish you and him the best, and I hope that is true because that would be a huge That'd be a huge boon for both of you, wouldn't it?
It would be. I personally don't think that's the case. Um, you know, they have bondholders that have to get paid out first. So I would presume that any money that they did have is going to their bondholders, and that's it. I don't think there's going to be any equity payout. I'd love to hear it though, so we'll find out.
Yeah, this
But
this
yeah,
this could all be misinformation, but I don't know. It's
yeah,
interesting one. Anyway, mate, I
I
do
was
have
told
to.
there were.
Oh, sorry.
Oh yeah,
You
I
wrap
say
up. No, you wrap up. Give us your final thoughts, and then we'll say goodbye.
yeah, real quick. Yeah, SoFi. See what the earnings bring. Very cautious going into the end of the year. Defaults have been going up, so that's a factor for personal loans. Um, and as far as Bed Bath and Beyond, they're all supposed to be worthless now. So, well, it was a fun ride.
I like it. And also one of mine that I've mentioned, obviously just Playboy thrown in there, still taking an absolute beating. This looking more and more like a zero. So yeah, anyway, we'll see how we go with that one, mate. But anyway, thank you for joining Wiz and I on We Hate Money, episode 6, I believe. So we'll see you next week, eh?
Yeah, see ya.
See you, mate.